Okay. We're back. Let's go.
Dangerous to gut the federal government, agencies that we depend on, and politicizing the work of agencies such as yours. Chairman Powell, this current president has tried to reclassify tens of thousands of non-political public servants just to make it easier to fire them. And that includes people who have served in Democratic and Republican administrations. It even includes people who serve in independent agencies just like yours.
We're back.
Chair Powell, as a chair who our current and previous president routinely has threatened to fire, I think I just heard something on CNN today while you were here testifying. But what effect has this policy had on the career civil servants in your agency? And are these threats making it easier or harder for the Fed to do monetary policy?
They're having no effect. We're doing our jobs.
You're doing your jobs. I appreciate you doing your job, even when it might not be easy. It is important to tune out the things that you hear on the media, because I hear it every day representing a district that has a lot of federal employees, a lot of people who work at your agency. I hear from people all the time.
Thank you, everybody. Welcome back. Had a light out here at the house, here at the whole zip code, so it's back. Love you guys. Welcome back.
In the country. Much of that has to do with our worsening housing crisis. And unfortunately, as we've seen with the past 6 months, this administration has been focused on this big billionaire bailout bill, gutting HUD, and releasing a budget that does not help the supply of fair and affordable housing nationwide. Now we've heard the president talk about having the power to control interest rates. In your opinion, Chairman Powell, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Sorry, if he were to what?
If the president has talked about having the power to control interest rates. In your opinion, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Honestly, it's not our job to speculate on things the president might do.
Sorry. So what impact do interest rates have on housing access?
Over the long run, they don't really affect housing supply. You know, assuming that rates will go up and down.
Well, not on the supply, but on the housing market. The supply is separate that we need to address going into this. If we're going to move interest rates up and down, that's not going to be the end-all be-all to getting people into housing. We must address the housing supply crisis. But what impact do interest rates have on the housing market in general?
Well, interest rates really affect housing demand. So with lower rates, you see more demand, and higher rates, maybe less demand.
Thank you, Chairman Powell. I am out of time, but I have lots of questions that continue to work to close the racial wealth gap in this country, specifically focused on my district in Atlanta, where it is so prevalent. Thank you so much.
Gentlewoman's time has expired. The gentleman from Indiana, Mr. Stutzman, is recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, great to see you. Again, as I've mentioned to you before, I always appreciate your steady hand at the wheel and not, I guess, getting out of your lane necessarily, but obviously you have a huge impact on the economy and what's happening there at the Fed. I want to kind of follow up a little bit on housing, as I've been hearing a lot about the housing concerns in Northeast Indiana, and I know you're not you're used to being beat up on a lot by folks all around the country, but I want to speak specifically to one particular individual, Grant Cardone. He made some pretty strong remarks about your policy when it comes to the housing industry, and he said, that's why you have 500,000 more homes listed than buyers for those homes. When the rates come down, prices will also come down with it, because you'll have more supply in the marketplace, and supply is what controls prices. He went on to say that interest rates do not control prices, and he explained that lower rates could stimulate activity in the market, and activity is what makes the economy work. And I agree with his comments, overall, but I believe, as you said earlier, the economy seems stable. And I would agree with that coming from an ag and manufacturing area. It's not booming yet, but I believe most people are optimistic that the good times are coming and that the structure is set and in place. But when it comes to housing, it seems like that's where a lot of Americans they're stuck. You know, they've had low rates, they've got a good mortgage rate, but if they want to make a move, they have to go out of that 3% interest rate into, 4.5, 5 or higher percent interest rate. Thoughts on addressing housing, because prices are up for sure, but there's no activity. The velocity is very slow. Would you like to comment on any of that?
Sure. We see the same thing you do in the housing market. It's tough. There's not people are locked in. They can't afford to get out of their house because the cost of getting to a higher mortgage, higher price mortgage would be a lot. So the best thing we can do, though, is to get inflation sustainably down to 2% and have it stay there over a long period of time. And that is really what we can offer to them. And I think, so if you go back to the beginning of the pandemic when we cut to zero and we did all those programs, we really saved the housing industry because they're the front line for interest rates. At a time like this, when rates are, I would say modestly restrictive, not even moderately, but modestly restrictive, they feel it and their customers feel it. We understand that, but we only have one tool for the whole economy, not just for housing. So it's something we consider, but we have to consider the bigger picture. And I do think in the medium term, as rates come down, you'll see normalization in housing. Of course, there'll still be a national housing shortage. I don't know about your district, but
yeah, no, there's a shortage.
Yeah.
I mean, considering the macroeconomics of interest rates, I mean, how much consideration do you take housing into that decision as you address interest rates?
We're always briefed on it. We always talk about it. We always look at it. But at the end of the day, it's the big U.S. economy, the whole aggregate thing that matters. We also talk about the agricultural economy a lot as well. But ultimately, and manufacturing, it's got to be the whole, and not any one particular piece.
Yeah, I just would mention it is hard for American families to make that move, and they're stuck. And so I would just highly consider, ask you to consider that piece of it, because when Americans can't move and Americans can't upgrade or move laterally even, it really keeps the economy kind of holds the economy back a bit when Americans don't have that. But again, I want to say thank you, because you have a tough job, but I haven't heard from anyone in my district asking interest rates to go up. So I'll just pass that along from Indiana's 3rd District. So with that, Mr. Chairman, I'll yield back.
Gentleman yields back. The chair now recognizes gentleman from Colorado. Ms. Peterson is now recognized for 5 minutes.
Thank you, Mr. Chairman, and great to see you, Chair Powell. Thank you so much for being here today. I want to thank you for your long service to our country. I know that you've served under many Democrats, Republicans. You've always been nonpartisan and done your job to put our country first, and we appreciate your steadfast leadership. And if you are not reappointed, it will be very missed here. I have some concerns when I think about, I know you've touched on this a little bit through the questions today, but around the independence of the Federal Reserve. Your job, no matter what president you served under, Republican or Democrat, was to make sure that this was not a political position, while you brought news that some would not be happy about because it reflected what you had to do to address inflation. When I think about the conversations we've had going through the global pandemic and the economic fallout, and how we had to infuse money throughout our country to keep our services afloat, our businesses afloat. And while we suffered from inflation like the rest of the world, we had the quickest, strongest recovery. We were leading the globe, and so much of that was because of your leadership. And so when I think about what this position means, how important it is that there is independence, what are your biggest concerns about a potential successor that doesn't prioritize that and wants to do what is politically asked of them versus what they need to do for the country, and what are their long-term repercussions if you're not acting on addressing the economic uncertainties and trying to address inflation in this position?
So I wouldn't speculate on that, but I would say, the credibility on the Fed on price stability is very, very important. People believe that we will bring inflation back down to 2% over time. And once if they really do believe it and it's true, then that'll have big effects on not just short-term rates but long-term rates. If that were to be called into question, then you'd see long-term rates go up. I mean, that credibility once lost is very expensive to regain, is what the historical record says. So I just think I think people should understand that credibility on inflation is hard won and something we need to constantly tend. And that's what we're doing with our current policy, is just being careful with potential inflation risks. We haven't overreacted. In fact, we haven't reacted at all. But we're being a little bit careful about that set of questions as we decide what to do next.
And thank you for bringing that up. As we look at where we were, how far we had come in our economy, things were starting to stabilize, and we were starting to finally see a relief on the interest rates. They were starting to go down. Now they're holding steady. Can you talk about why the instability? When we look at tariffs around the increase in the deficit by the proposed big ugly bill that is being brought through Congress right now, and increasing our debt by trillions of dollars, and having our credit downgraded again because we are increasing our deficit. So with this economic uncertainty, where we were going, we were on the way down for reducing our rates, and now we have to hold steady to address the instability. Is that correct?
I'm sorry, could you just briefly restate your question there? I apologize.
Yes, I'm going to do this the best I can with with Sam here. That with our having to address inflation, as we've started to see it, you were able to decrease the rates. We were starting to go down a little bit. We were seeing that our economy was finally in a solid place. Prices were starting to go down. And now, with the economic uncertainty, we're starting to see that you had to hold steady, whereas everyone was projecting before this administration came in with these changes that it was going to continue to go down. Can you talk about why you have had to choose to hold steady on the interest rates?
So we just, we stick to what we're assigned to do, which is maximum employment and price stability. We don't have opinions on fiscal policy or trade policy or immigration policy or any one of another, or regulation policy, other than that we have our regulatory responsibilities. And so we take what comes as it comes. And, elected politicians do what they do, and we don't criticize that. We don't have opinions about
Gentleman's time has expired, and the gentleladies.
Thank you, and thank you, Sam.
The chair now recognizes the gentlewoman from Texas, Mrs. De La Cruz, for 5 minutes.
Thank you so much, and thank you, Chair Powell, for being here with us today. I am Congresswoman Monica De La Cruz, and I am from deep South Texas, a largely Hispanic district, a rural community right there on the border of Texas and Mexico. I serve as the Vice Chair for Housing and Insurance Subcommittee, and it's difficult for families right now to afford a home on an average paycheck. I'm committed to finding affordable housing solutions for the people in my community, but also for all over the nation. So, Chair Powell, mortgage rates remain significantly elevated relative to Treasury yields, with spreads well above historical norms. To what extent does the Federal Reserve believe its balance sheet policy, particularly the runoff of MBS holdings, is contributing to this widening, and how does that factor into your broader assessment of financial conditions?
I don't think that our runoff of MBS is a particularly large contributor to that situation. I also think it's not just interest rates, it's so many things around housing now. It's insurance, it's materials, it's land acquisition, it's labor. There's so many cost pressures that are pushing up housing costs.
Thank you. With that being said, moving on to an entirely different topic, if the Federal Reserve focuses on issues outside its dual mandate, there are more opportunities for policy mistakes. How can you ensure that no other climate policy work is being done at the Federal Reserve?
So it is a big risk to our independence if we were to stray into areas where we shouldn't, that really aren't part of our mandate. And I would agree that climate is the biggest risk. So we really did the bare minimum. We did much less than I think people understand in the climate area. All we did was one piece of guidance, and then we ran one stress scenario, and by the way, didn't find anything. And I think you don't look to us to try to take on a bigger role or really to play any role in climate, which I personally think is an important issue and one that needs to be dealt with by elected officials. And for bank regulators just to step in and take that on without a mandate from Congress is not a good idea. It's not a good solution, and it's not a good way to remain independent.
Reclaiming my time, what kind of climate guidance did you make?
So for just the big banks, I believe, we asked them to monitor to have a framework for which they would monitor their risks from lending. That's all it was. And I would say that that guidance is something we're looking at pulling back.
When you say the risk for lending based on political climate change, is that correct?
Well, the idea was that the changing climate could, I'm not defending this, I'm telling you what the idea was. The idea was, climate change would cause certain kinds of assets to lose value, and that if banks are lending to in those areas or to those industries, then they should at least be able to measure. It didn't ban anybody from doing anything, it wasn't prescriptive. At the same time, you have the feeling that the side effect of it would be to discourage lending, and we don't want that to be the case, so that's why we're looking at it.
Well, it does sound like that is policy that is based on political agenda. And when it comes to banking, it should not be based on political agenda, but instead on facts such as credit, facts as good monetary policy. So I would have to disagree with you on the fact that the Federal Reserve stayed outside of political agendas. When it comes to climate change, that is a political agenda, and I would have to disagree with you on that. Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from California, Mr. Sherman, who's also ranking member of the Capital Markets Subcommittee, for 5 minutes.
We don't notice good bank regulation. Things just go smoothly. But in 2023, we saw the effects of inadequate bank regulation, where we lost 3 banks. There was a proposal that passed the House that would have cut the pay rate of your bank inspectors and regulators down to 70% of the rate paid at FDIC. So you would have been 70% of what the other major bank regulation agency did. I know you've announced things about headcount, but I'm focusing here on just the rate of pay. Fortunately, we were saved by not Superman, but Superwoman, Elizabeth McDonough, the Senate parliamentarian. But what effect would it have had on our ability to have good bank regulation if you had to go to all the folks in doing bank regulation at the Fed and say that their pay is going to be cut to 70% of the rate of pay over at the FDIC?
Would have made it harder for us to attract or to retain personnel. It also would have knocked down something we've had for 90 years, which is a sort of a moat that allows us to take care of HR issues on our own without Congress.
Gotcha. I've got a couple of questions I'd ask you to respond for in the record. The first is Section 899 of the big ugly bill, big beautiful bill, whatever you want to call it, enforcement of remedies against unfair foreign taxes. What this does is it imposes a tax on those residents of about 24 foreign countries should they invest in the United States, including in our treasuries. And we're trying to attract capital from abroad. This is to push out capital abroad. It doesn't affect China. It just affects 24 of our friends, particularly in Europe. The other thing I'd like you to respond for is the record is the tariffs and the effect that that has not only on the inflation rate, but therefore on interest rates. And at your press conference, you said increases in tariffs this year are likely to push up prices and weigh on economic activity, and I'd certainly like to know more about that. The Treasury has our reserves, but you also have a liquidity fund, which I believe involves buying and selling foreign currencies. And so that begs the question whether if you're allowed to buy the euro, whether you're allowed to buy cryptocurrencies. And of course, the president has said that some agency of the federal government should have a strategic crypto reserve. Do you or your successors have the legal right
Crypto?
to take assets of the Fed and buy Bitcoin or Trump coin?
No, we don't, and we do not seek this authority.
I hope very much that your successor is not someone who tries to stretch existing statutes and come to an opposite answer. I'd like to focus a little bit on when you came before our committee last, I guess, in February. I asked you if you would take a holistic look at bank capital requirements, including the risk-based capital ratios like Basel III Endgame and stress testing, to make sure that you don't have a contraction in the ability to provide credit to Main Street businesses, and you said you would do that. So my question this time is, how does the Fed plan to sequence the various capital requirement reform proposals that we expect to see in the coming months? In what order will you proceed with reforms on Basel III weight risk capital, leverage ratio, stress testing, and the GSIB service charge, knowing that these have interactive effects? Can you tell us what the sequence will be?
So I really do. This is the heart of what the Vice Chair for Supervision is assigned to do, is to bring proposals to the board, and I read that as giving her she's the one who will decide that sequencing. You're right there. There are many things, and it's really up to her to decide what's the timing, what's the priority, and I don't actually know exactly what she's only been confirmed for a couple of weeks, so we're just getting going.
With you as the head of the agency, even if she is supposed to decide the sequencing, that your agency would tell us what the sequencing is going to be, and understand how important it is for people to know what the order those various regulations
Gentleman's
will
time
have,
has
and I
expired.
yield back.
Gentleman yields back. The chair now recognizes the gentleman from Iowa, Mr. Nunn, for 5 minutes.
Well, thank you, Mr. Chairman, and thank you, Chairman Powell, for joining us again here. We have a saying, Iowa is nice, kind of boring. We want our Fed chairman to be just the same, and you're doing a great job at that. We appreciate it.
Thank you.
Nothing against boring. We like that, too. Look, you have a lot of great staff that come from Iowa as well. I appreciate you having them on your team. We also want to recognize the fact that, folks in Iowa are still feeling the challenges of the last 4 years. We're middle America. It is the heartland of the country, but it also means that impacts that change things on the coast don't always get felt the same way in the Midwest. And so as a result, folks are stretching every dollar as they face everything from higher grocery prices, eggs, to trying to buy just that first car, or even maybe that first home. And interest rates to them matter as they do everywhere else, but they're even more. Now, I will offer, the president has made great strides in making progress for Iowa families, and wage growth is moderating nationwide. Many Iowans still feel, though, that inflation spikes impact them. And with the president focused on rebuilding the middle class, I'd like to talk a little bit about how the Fed ensures that this heart of the heartland can feel the benefits of a soft landing as you've laid out.
Oh, you're asking me how you will feel the benefits of the well, I would think, pretty open-ended question. So I think, our goal is to keep the economy strong, the labor market strong, and price stability fully restored. So that's really what we can provide, is a long period of stable prices. And we define that as Chairman Greenspan used to, which is people can make economic decisions in their families and their jobs where they don't have to think about inflation all the time. And we're getting back closer to that place, but we're not quite there yet. That's the main thing we can now do. And once we restore price stability, very soundly, that gives us the ability to react more strongly to downturns in the economy without having to worry about inflation. And so that's, we have limited scope, but those are two very, very important things that we can deliver that benefit all families.
I would agree. So I guess I would also like to focus here on the short term. The Fed Reserve has slightly lower rates to ease borrowing costs for rural communities, and long-term trade negotiations to strengthen our global position. Would you agree that the agricultural sector in particular is vulnerable to both interest rates and recognize international markets? And how would the Fed evaluate the unintended consequences of policy on commodity-dependent economies in a state like Iowa?
So we have a number of our Federal Reserve Bank presidents represent districts which have extensive agricultural operations and families and farms. And so we hear from them kind of all the time, but we hear from them in great detail around every FOMC meeting. And we understand that times, pretty challenging right now in the agricultural sector. We take that into account. Ultimately, we're responsible for the aggregate level of the economy and for keeping inflation under control and maximum employment. So, but we do very much think about and take into consideration the agricultural sector and the people in it.
We appreciate that evaluation. I know there are farmers back home as well as, our bankers who value that because they're the one providing the capital for it. I want to talk a little bit on the national security side, as the rising treasury sales or dollar reserves. What tools does the Fed have to help preserve financial stability and the dollar's status as a reserve currency within the world?
Essentially what makes us the reserve currency is a few things. It is our great democratic institutions. It is that we have open capital markets, very open capital markets, and it is that we have price stability and the rule of law. Those are the things that make you the reserve currency, and you can keep that status as long as you maintain those things. Of those things, the thing that we contribute is price stability over the long run. So people who want to invest in or use the dollar, they can be confident in the value of the dollar over time, that it won't fluctuate wildly or decline in ways that, and so that's our role. Really, Treasury is responsible for stewardship of the dollar, but we have that role to play as well.
Very good. In the brief time that I have left here, I just came back from a trip to Saudi and the Arab states. Big concern here in the world we're living in right now, with Iran looking at asymmetric ways to threaten the United States. Cyber attacks have been on the rise. You got a question here earlier on cybersecurity. Help us feel confident the Fed is doing everything they can to protect us from a cyber threat.
So our part of it is the financial sector and the institutions we regulate, and they spend a lot of time and money on cybersecurity. We spend a lot protecting ourselves, and there are other parts of the U.S. government that are very much involved in making us aware of cyber issues and making sure that we're all ready. And we never sleep on this because it's always getting harder.
Thank you, Mr. Chair. I yield my time.
Gentleman's time's expired. The gentleman from California, Mr. Vargas, who's also a ranking member and my colleague on the Monetary Policy Task Force, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you, Ranking Member. Appreciate it. And of course, Mr. Powell, thank you very much, Chairman Powell, for being here. I'm 64 years old. You're a little bit older than I am. In my lifetime, I know what the most dramatic economic event is, at least that I believe. In your lifetime, what do you think is the most dramatic economic event that you lived through? As a country, as a world?
So as an adult, I would say the global financial crisis and the pandemic are
no, just one. You get to pick one.
Big events. Sorry?
You get to pick one. You pick two, just one.
I would say there's a third, which would be the great inflation, so I'm going the wrong way here.
You're going the wrong way. Yeah, just pick one.
I'd say the global financial crisis was, in a lot of ways, scarier than the pandemic for me.
Yeah, it's interesting because both of them were ones that I lived through too, and I have to tell you, the most dramatic for me was the pandemic. In so many ways, I'd never seen anything like it, where everything closed down. I remember flying here from San Diego, where I live, on a 737, and there were 4 passengers. There were 4 of us on the plane. Of course, some idiot sits right next to me. I tell you, what are you doing? You stupid, move away. But anyway, it is interesting that we didn't fall into the recession. We didn't fall into a depression. I was really scared about what was going to happen because of the way we closed down. We didn't know it was going to go. We didn't know it was going to happen. And I think a big reason for that was the sort of the strength that we had at the Fed, and the country came together and said, we're going to figure this thing out, and we did that. You didn't panic. You guys were very independent. I think everyone did their job. The reason I say that is because I do worry about the independence of the Fed now going forward. So a question, can the president appoint himself as the Fed chair?
It's a question, but not for me.
You're the Fed chair, you should know. You should know what the requirements are to be the Fed chair. Can he appoint himself?
I don't know.
You don't know that question? What is, well, you're the Fed chair, what is the requirements to be the Fed chair?
Nominated by the president, confirmed by the Senate. I think you probably have to be a U.S. citizen, probably, but I'm not sure.
Okay, so far it seems like the president fits those. He's a U.S. citizen. He can propose himself, and I assume that the senators over there could confirm. Why couldn't he become the Fed chair also?
Again, not a question for me.
Okay.
I wouldn't speculate.
The reason I ask that is because, again, I do think that we have a great system because of the independence of the Fed. And it worries me that more and more, and I assume, I'm not going to ask you this embarrassing question, although I would like to, whether you read all the things that he says about you. I'm sure you do, or some people tell you. Yeah, but I won't tell you what they are. But I'm glad you've been independent. And I think that that's so important because you do look at long terms. It's not missed on you. You know that we want you all to lower the rates. You know that, both sides, right? You get that. The answer could be yes or no.
Honestly, I'm not sure I do know that. I talked to a
Well,
lot
I
of
can
members
tell you, from our
privately.
side, we'd love to see the rates go down. And I've heard from a number of my colleagues on the other side, we'd love to see the rates go down.
I talked to
I
a
think
lot of
that pretty
members who
unanimously
say
would like to see it.
privately, you're doing the right thing. I hear that from a lot of members privately.
Yeah, oh,
But in any
good.
case, we have to do, you were appointed and confirmed, my colleagues and I, do what we think is right.
That's exactly right, and that's why I say it, because I think it's not lost on you that we all want the rates to go down. In fact, it's really real when you say, if someone's locked in at 3% at their house, their interest rate, so they don't want to move and get a 7% rate. I mean, they don't want to pay that. That's real. My colleagues mentioned that, and that's truthful. And that's why it's so important to be independent. Now, lastly, I do want to ask, because again, it's so darn important to have an independent Fed chair and an independent Fed. Secondly, the dual mandate. I respect the chairman very much, and he's a friend. I hope that doesn't hurt him politically. But that being said, he did ask you a question about the dual mandate in a way that he quoted somebody else and said, is that the way you see it? I do want to see, how do you see the dual mandate? It seems to me that you gave a little bit of a preference to price stability over maximum employment. Is that the case?
No, I think the two things are equal under the law. But if the thought is, we haven't defined it in exactly the way that the chairman said, but notwithstanding
agree
that, I
with
do
it.
think it's a reasonable way to define it, which is the maximum employment is the maximum level that's sustainable or consistent with price stability over the long run. That doesn't make it, to me, an inferior goal.
Gentleman's time has expired.
Thank you.
I think it's
you,
kind
Mr.
of
Chairman.
implicit in a way.
The chair now recognizes the gentlewoman from Michigan, Ms. McLean, for 5 minutes.
Thank you, and thank you so much for being here. I appreciate it. As a business owner, small business owner myself, access to capital is extremely important to me. So I want to talk a little bit about the Fed's balance sheet and just get a better understanding of how we're thinking about it. I mean, some experts say that the Fed's balance sheet or large balance sheet is distorting the markets and keeping long-term rates, let's say, too low. Also, I think it limits the access to capital, right? Historically, if I'm accurate, the balance sheet's been about $4 trillion prior to the pandemic. Then we raised it, we almost doubled it to about $9 trillion, and now it's on a kind of a downward trajectory to about 7.2, again, if my math is right. Do you think we're on the right track in shrinking this balance sheet?
I do, yes.
I'm trying to get a sense of what the landing spot, in your opinion, should be. Do you think we'll get back to the $4 trillion?
No. So we're in what we call an ample reserves regime, and what that means is that the quantity of reserves, demand fluctuates, and this means the quantity of reserves can fluctuate without affecting interest rates. And we think that's a good thing. What that means is there's going to be a lot of liquidity in the banks and in the financial system. That's a good thing. There wasn't enough liquidity before the global financial crisis. That was one of the problems. We have some shrinking left to do on the balance sheet, but we're not going to get down as far as you asked.
Where do you think we'll land? Because let me start. I'm sorry. Where do you think we'll land?
You know, I can't give you an exact number, but we're going at a pretty modest pace now. We've slowed down, kind of cut in half twice the speed. We think we can go for a good while at this speed, and we'll learn as we go.
So you think the trajectory, so to speak, will remain?
Yes, and I think the fact that it's quite a gradual trajectory now is going to enable us to find that level that is ample and not scarce. When reserves are scarce, you get a lot of volatility, and that doesn't help. So I think that's a good framework. The ample reserves framework, I think, serves the country well.
And you're not concerned in terms of the access to capital? I mean, as a business owner, that's what I look at, is I got to be able to get capital, and some people are saying, we're really hanging on to our cash.
I think honestly, I think if you took the trouble to go back to a much smaller balance sheet, it would have no effect whatsoever on capitalability for companies. You wouldn't do that at all. We're not pulling capital away from companies. That's not what's happening. It's just you have a big balance sheet where there's a lot of liquidity. The result is there's a lot of liquidity. Banks are flush with liquidity for the most part, and that actually enables lending. It probably wouldn't have much of an effect one way or the other if you went back to a smaller balance sheet.
So you're comfortable with the liquidity? You're comfortable with the access to capital? Excuse me.
I mean, we look at credit availability for smaller businesses, and right now conditions are a little bit tight.
Yeah, it's tough for people in my district.
I would say that they're not terribly tight, but we do see that there's some tightness. But that's not really a function of the Fed's size of the Fed's balance sheet. That's just that banks are perhaps a little risk averse in this uncertain environment.
I think it all
cut the rates.
Goes together and is kind of intertwined. But I appreciate that. I want to just switch gears a little bit. Are you seeing any signs of financial instability building beneath the surface that we may not be seeing maybe on top of the surface, whether it's in commercial real estate, private credit, regional banking, anything you're seeing underneath the surface that could derail the growth path?
Not really, no. I mean, you mentioned there are a lot of pots that we need to watch to see that they don't boil over. CRE, has been a problem for 5 years. We're working our way through it. I think we're making good progress there. It's not getting worse. It's getting a little better. Private credit is, has its real positive attributes. It's not funded by deposits, so it's not, as long as it's not funded by retail or by deposits, it's actually fine for financial stability, but it's a very big and fast-growing sector, and it hasn't been through a real downturn, and it's quite diverse, so I think it bears close watching. I mean, asset prices are high, but leverage is not particularly high for corporations and households historically. It's not particularly high for banks. Banks are well capitalized. So I think overall financial stability conditions are not in a place where we worry a lot.
So we're really poised in a pretty good position economically.
Gentlelady's time has expired.
Absolutely.
Thank you, Mr. Chair. Thank you.
The chair now recognizes the gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Mr. Chairman, and Chair Powell, nice to see you again. We had spoken in February about some concerns I had about some of the cuts in some of our economic data reporting agencies, and I think you'd said at the time that you didn't have a concern, but if you would alert us if there were concerns. You'd mentioned this with Mr. Liccardo, and I gather, if I'm paraphrasing you, I think you said that you're not concerned about your access to data right now, but I think you said that you don't like the direction of travel. I wonder if you could speak to, well, first, I'm going to work under the assumption that as the chairman of the Fed, you probably have more access to economic data than just about anyone in our country. I am more worried about the impact on smaller businesses that don't have your access to data, whether, someone thinking about hiring decisions, looking at regional inflation rates, all the data we get from those resources. How concerned should we be, if an efficient economy depends on, at some level, on equal access to information? How concerned should we be that our business community, with some of these cuts to BLS and elsewhere, is not going to be able to allocate capital as efficiently as otherwise would be in this moment?
The reality is that essentially all the data we use overwhelmingly is public data. The difference isn't that we have more access. The difference is that this is our job, and we follow the data very, very closely. But, the employment reports, the CPI reports, the analysis of that by many economists, internal and external. We just spend all of our time on this stuff. But I think large businesses have the exact same.
Well, but I'm talking about
businesses, not
BLS has announced they're cutting 350 indexes, so that data is no longer going to be public data.
That's a different thing. Okay, so if you're asking about that, I don't want to say, and it wouldn't be true to say that we can't do our jobs with the data that we have now. That's just not true. The data overall, we get the data. It's all these jobs you're always going to make mistakes. It's never going to be certain in any time. But I would say, seeing that survey sizes are shrinking and we're seeing more volatility, for example, in the labor market data, lower response rates and things like that, that's not good. We should be getting better and better and better. Yeah. I would add the private sector, by the way. We use more and more big private sector data sets, and that is a relatively new thing for the last 5 or 10 years.
Yeah, and oftentimes
it doesn't replace the U.S. government data has been the gold standard.
Yeah, and I guess I get concerned because some of those data sets, of course, you have to pay for, and not every business can afford that. I want to, staying on the data point and picking up on what Mr. Himes was saying, I think only a fool would predict they know what's going to happen in the Middle East right now. But I get concerned that we have, trying to handicap, the Saudis have been very open that they would like to not see the price of oil get above a point where they're going to lose market share, much to the dismay of U.S. frackers. U.S. frackers have been wanting to see it go the other direction. I don't know how to handicap which group is going to have more impact on Trump right now. But I would like to have some smart person out there taking a position on what is happening in oil markets. And the Energy Information Administration has now announced they're not going to run the International Energy Outlook anymore. Should we be concerned about that piece of data as we think about what's happening in global energy markets right now, given all the pressures between various suppliers of where they'd like to see the price go and the wild card that is Iran and the Red Sea?
I don't particularly know that specific report. I know there are many entities that do data analysis around energy and oil and the availability of it and the price of it and all those things. So I can't speak to that one report.
Okay, well, again, just my own experience before coming here, I relied a lot on that, and if I was in my past job, I would now basically have to rely on the International Energy Agency, which in general was not as robust as the DOE data. And so it's a gap. And I guess maybe I'll just close with, I think a lot of this gets tied together with the Office of Financial Research, which would presumably be synthesizing a lot of this information for you. Your predecessors, Janet Yellen and Ben Bernanke, both recently urged the opposition to cuts in Office of Financial Research that are in the bill that the Republicans are pushing through. Do you share your predecessors' concerns about the importance of that agency to synthesize some of this disparate things so that you can do your jobs, that the American people can do your job, or do you share the views of the Republican Party that agency is not necessary?
I'm not going to take a position on the bill, on the reconciliation package on specific issues like that don't relate to us. I will say generally, I'm a big
Gentleman's time
fan,
has
and everyone at the
expired.
Fed is a big fan of good data collection.
Gentleman's time has expired. The chair now recognizes the gentleman from Montana, Mr. Downing, for 5 minutes.
Thank you, Mr. Chair. Our national debt now exceeds $36 trillion. Congressional Republicans have made it our mission to rein in out-of-control spending, from repealing the Green New scam, enacting common sense Medicaid and SNAP reforms, and rescinding wasteful spending. Mr. Chairman, you've repeatedly said our national debt is not currently at an unsustainable level, but it is on an unsustainable path. Can you describe what the point of no return looks like when our debt reaches an unsustainable level?
So there's no way to know exactly what that is, but ultimately, if the debt is growing substantially faster than the economy, by definition, at some point, it will not be sustainable. So, we don't have oversight responsibility over the fiscal authorities, but that's traditionally what my predecessors have limited themselves to saying, and I'll say it too.
And what effect would that have on the economy?
So you'd see rates go up. It would be very challenging to. I think if you wait too long to fix the problem, you'll have to fix the problem eventually. If you wait too long, it'll be much more painful.
Yes. I believe the U.S. dollar status as the global reserve currency is essential. It allows the U.S. to borrow at lower costs, which stimulates economic growth and increases standards of living. The Trump administration is actively negotiating to ensure we are no longer taken advantage of by our trading partners. At a previous Monetary Policy Task Force hearing, all of the witnesses agreed that the recent volatility in the Treasury markets did not permanently damage the dollar's global reserve currency status. Do you agree?
I do.
Thank you, sir. Let me turn to oversight of the Federal Reserve. I certainly believe that had the Federal Reserve responded faster by raising interest rates earlier to combat the inflation crisis of the previous administration, that interest rates would not be as high as they are now. I hear frequently that from my constituents that they're increasingly getting priced out of the housing market while interest rates remain near record highs despite the rate of inflation coming down. So, Mr. Chairman, I appreciate the Fed's increased transparency under your leadership, and you've always welcomed congressional oversight into the Fed. And I also appreciate the comments you've made about the limits of our knowledge demanding humility. So with that in mind, can you point to oversight practices of other governments into their central banks that could be replicated with the Federal Reserve?
That's an interesting question, and I want to think about that. I'll come see you and we can talk about that. I think
you, sir.
we have effective oversight from this committee and from the other committee in the Senate, and I think that's important.
Would you be supportive of an outside independent group of analysts or economists that conducts a periodic review of the Fed's economic assessments and modeling?
Yes.
So those are ideas I'd like to think about and discuss privately
Think about
before.
what?
So do you have any other ideas to increase oversight in the Federal Reserve?
I think, like my predecessors, I've fostered, more and more transparency at the margin, and I think that's appropriate. I think transparency is critical if we're to maintain our democratic legitimacy. So I've tried that, but I'll devote some more thought to that question.
Well, I look forward to following up, and I thank you for your responses. And on that, Mr. Chairman, I yield.
Gentleman yields back. The chair now recognizes the gentleman from Texas, Mr. Gonzalez, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here with us today. I understand commenting on some policy issues or outside of your purview, but I have one that I think is heavily impactful on the American economy right now, and I want to underscore the scale and impact of the ICE raids that we're seeing across the country. Pew Research estimates that over 10.5 million undocumented individuals live in the United States, more than 3.3% of the population today. And according to the nonpartisan American Immigration Council, removing this workforce could cost the U.S. economy between 1.1 and 1.7 trillion in GDP and billions in tax contributions, including 22.6 billion in Social Security and 5.7 billion in Medicare funds that are increasingly critical as our population continues to age. These are resources that are paid by these undocumented have been here for a long time. Many of them have been here for a very long time. That's why I plan to introduce the Save the American Workforce Act, which would establish an employee-sponsored temporary work authorization for undocumented immigrants who have been in the country for 3 years or longer and have never been in any kind of trouble, no criminal liability or nothing else. Additionally, last week I sent a letter to President Trump urging him to halt indiscriminate deportations and issue an executive order that would do exactly what my bill does to protect American businesses that need a workforce. We have the last I heard, I think we have 7 million open jobs. We have a record low unemployment, which is great, but we have 7 million open jobs that we cannot fill by American workers. What economic consequences would we face if these individuals were removed from the workforce, even further hurting the situation that we're in? Could this disrupt even more the economy even more severely than what we experienced during the Great Recession?
So, as you might expect, Mr. Gonzalez, immigration policy is just not for the Fed to comment on or to, let alone make, and so I'm reluctant to engage with you on that.
Okay. Okay, I want to talk to you something a little differently. We have, and this is a banking issue, banks are making, billions of dollars of construction loans across the country that are timelined, and contractors are not able to fulfill their obligation because they don't have the labor force in the middle of the jobs to finish. I mean, I'm hearing stories in Texas, at least, where people are pouring concrete at midnight. Are y'all having any kind of conversation with the administration on how this could impact the economy and our GDP?
So we have very deep connections all over the country through the reserve banks, and we hear some of the same stories. But for us, we're not the policymakers here. We don't report this to the administration. We don't just publicly have a view on it. It just is what it is. So
yeah.
We're our responsibility, maximum employment, price stability, many other factors affect those goals, but we don't make those goals. We don't make the policy in those extraneous areas, which include things like energy, for example, or immigration, or fiscal policy, or any number of things. We try to stick to our knitting because that's how we remain independent.
Yeah. We're living such unconventional times that I would love to have that. It would be great if y'all were having those conversations in the administration. But moving on, the U.S. dollar has also long been the world's dominant reserve currency, but that position is facing growing pressure. As of 2024, BRICS nations led by China and including Brazil, Russia, India, and South Africa have stepped up efforts to reduce their reliance on the dollar in global trade. China, for instance, has expanded the use of the yuan in energy transactions and cross-border payments, while BRICS is actively developing alternative payment systems that could erode the dollar's global role. At the same time, inconsistent and unpredictable economic policies from the White House have contributed to a drop in the dollar's value, now at its lowest level in 3 years. What risk does a weakening dollar pose to our economy, particularly to U.S. borrowing costs, inflation, financial stability, as China and BRIC nations expand their efforts to challenge the dollar's global dominance?
So, by long agreement and custom and tradition, the Treasury Department has responsibility for the dollar and dollar stewardship. I would say we also, are involved in payments policy, and we're very aware. We and the other major economy central banks are very aware of other payment developments, and working on ideas to make sure that the payment systems that support the dollar and other other major currencies of the democracies are well supported by that infrastructure.
Thank you. I yield back.
Gentleman's time has expired. The chair now recognizes the gentleman from Florida, Mr. Ardopoulos, for 5 minutes.
Thank you very much, Mr. Chairman, and thank you, Chairman Powell, for being here today and answering these questions for us. It's very much appreciated. Looking back over the last few years, I think the question a lot of people have been asking me as they really were suffering through the challenges with higher prices across the board. I know they got as high as over 9% inflation in 2022. And there was a lot of discussion about, was it Ukraine, was it transitory, was it post-COVID? What was the reason? As you look back now in those years, and this is your field of expertise, if you look back and you're teaching a history class, what would you blame the increase in prices on back at that time period?
So I'll start with the fact that it was extremely global. So we saw there literally was a point at which not a single country in the world had inflation 2% or below. So it was everywhere. So you have to look to common factors. And I would say that the pandemic and the closing of the global economy and then the reopening of it, in all cases with some support, that's a big part of the story. Clearly, though, there's a role in that for fiscal policy. There's a role in that for monetary policy. And I like to think all of those factors were involved. And but when it happens everywhere in the world, you can't look to one thing. You got to look to something, a common factor. And I think that common factor is what happened around the pandemic.
Sure, good. And build on that idea, I know I hate it Monday morning quarterback, but if you had to do it over again, you had this opportunity, as you know, the rates stayed pretty flat in 2021 as inflation creeped up. What would you do differently today if you had the opportunity to look back and make some changes?
I have perfect hindsight in this.
Yes, sir, if you had it, yeah.
Sure. So clearly I would have raised rates a little earlier. I honestly don't believe it would have made much difference to the outcomes, but we would have looked a lot smarter. But that's something I would have done. The other thing is, ultimately, we did get all the way back to 2% inflation just about without having a big increase in employment. So that was not at all expected. So I don't know how that would have affected my behavior, but somehow things really came out much better than everyone had anticipated, was that it would take high unemployment to restore inflation, but it didn't.
And the other pressure point that I hear a lot of people talking about is this idea of the tariff issue. I've heard for months now that the sky is falling, but it seems at this point at least that the inflation rate is pretty steady. And how many months of steadiness do you need before you might look at an even larger rate cut from the 4.33 I think we have today?
Yeah, so you're right. Inflation, the non-tariff parts of inflation that we've been working on for 3-4 years are behaving really well. And that was our forecast, but it's good to see it coming true. I would say we expected that tariffs take a while to work their way through the distribution chain, several months. And I would say we would expect to see meaningful effects, kind of June, July, August. And if we don't, we'll be learning something. We have a highly adaptive, flexible economy, and it's certainly a possibility that the tariffs that we expect will come through in a much smaller level. We can't know that until we actually see it, but I think we'll be learning as we go, and if we see that, then that would lead us to want to cut earlier. The other thing that would lead us to want to cut earlier is if we actually did see some weakness in the labor market of a troubling nature, and we don't see that. Those are the two things we'll be looking for.
And the last question I'd ask is, at that same time period where, as you put it, the global issue of inflation, I get that, but at the same time period, there's pretty radical increase in spending in 2021 by the federal government. What factor did that play in the inflation level?
Certainly a factor, I would say. As I mentioned, fiscal policy definitely played a role. I think if you take a step back from those things, what happened was demand came back so much stronger than we expected. You remember, if in late 21, early 22, you had the pandemic still going on, Omicron going, was it 21? Yeah, 21 into 22. And demand was just much stronger than people expected. And by the way, the supply side was much slower to recover. So that's the labor force, that's all of the snarled up supply chains. The supply side took a long time to recover, and demand was much stronger. That story created the high inflation. Behind that, fiscal policy played a role, the spending did, monetary policy played a role, and the pandemic.
But you would agree that the government spending did play a significant role in that as well?
Yeah, I would say that.
Okay,
Yeah.
thank you. Thank you, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Illinois, Mr. Foster, who's also ranking member of the Financial Institutions Subcommittee for 5 minutes.
Thank you, Mr. Chair. Following up actually on Rep. Gonzalez's line of questioning, so in addition to your dual mandate, do you believe that that preserving the U.S. dollar and the primacy of the U.S. dollar is part of your job description?
I think it's not formally part of our job, but yes, it's something that we care about, and we certainly wouldn't want to undermine that. But that's really, Treasury has the primary role around the dollar. That's been the case for some time now.
Yeah, I was just wondering how you deal with the sort of worldwide drop in investor confidence in dollar-denominated assets, frankly, due to a president who kind of disregards conventional economic theory and whose answer to nearly every question seems to be, well, I haven't decided yet, or maybe I'll give you an answer in a couple weeks. Maybe I'll just comment, it must be challenging. Now, one of the things I've been very concerned about is, in terms of the job market, is artificial intelligence and the coming impact there. We're seeing predictions by the leaders of the leading AI firms that within 1 to 2 years,
The fam. 2 hours of 2 hours plus of listening. That's a lot, right? We got our light went out here at the house, but thankfully it's been an hour now that we're live. So my community is the best one. Everybody, he's not gonna be cutting rates this July. It's not gonna happen. He first has to see what's gonna happen with the tariff impact. That's gonna come in Q3. Q3 starts in September or so. August, September. So we're gonna have all summer no cuts. FYI. Is that what everybody wants? No. But after listening for 2 hours, having fun with you, I know it's not going to be fun. And this guy is not talking about anything that will carry a headline that Trump wants to see. So yeah, he's respecting, banks to have clients in the crypto space. That's good. He said it. He's not going to meddle in, cutting ties with the crypto digital asset industry. That's good. But right now, some good questions, some other crazy questions, right? We had everything here, but I want to say thank you, fam. You're awesome. Thank you to my mods. Thank you to my members. Thank you to everybody. Drop a like, subscribe to the channel. This is what we do, guys. Tomorrow is going to be the Senate. So this is the House. It's going to continue for a little bit longer, but the Senate is coming tomorrow. That's going to be big. Senators usually have more to say, so it's going to be good. See, I know more senators than House members, but get ready, buddy. Links down below. Join me on BTCC immediately if you haven't already, guys. We bought the dip 2 days ago, and we're doing very well. On traderamos.com, there's my Telegram group. It's completely for free. I'm posting my updates, and join me on Discord. We got an amazing community out there. I want to say thank you guys for coming in. I'm going to go ahead and relax. It's time for me to relax and enjoy. He continues, but yeah, after hearing 2+ hours, I think it's enough. Okay? God bless you all. Please stay safe. TJ, Ghost, members, and more, you're awesome. I'll see you next time, and let's see what happens. Trump is arriving, right, to Netherlands soon, and he is going to be speaking with NATO countries. And yep. We'll have more to say, but it's going to be fun. Go ahead and relax and enjoy. Have a good one, guys. Take it easy. Peace. Cut the rates. Cut the rates. Peace.